Hi, welcome to week 4 of our course, Corporate Governance and Corporate Social Responsibility. Today we'll be talking about the topic of institutional investors and the market for corporate control. This extends the topics on share ownership that we had last week, and will bring you up to date on these topics. So we'll start today by talking a bit about the history, picking up on Berlin Means in the era of managerial capitalism, and we'll ask whether or not this holds today or whether we've moved on to a new kind of investor capitalism. We'll look in particular in some detail at the topic of shareholder activism by pension funds. Then we'll touch more briefly on two other topics on the world of socially responsible investment, SRI funds, and we'll look at the role of hostile takeovers as a market for corporate control that can play an important role in corporate governance. So a topic from last week was managerial capitalism. We read Berlin Means, who showed the degree of ownership dispersion in the 1930s in the United States of America. If owners are dispersed with only small stakes, for example 1%, Berlin Means argues that managers actually control the corporation completely. This gave rise to something analogous to the classic agency problem concerning how shareholders who had very small stakes can effectively monitor managers. The separation of ownership and control remains a major problem of corporate governance today. But today, the situation has also become something more complex. When we look at the evolution of share ownership in the United States for over a long period of time, say the end of World War II in 1945, up to the beginning of the Lehman crisis, the financial collapse in the year 2008, we see a big change in who are shareholders in this period. So if you look at the top line of here, in 1945, 93% of shares were owned by the general public, ordinary individuals. This is very similar to what Berlin Means talked about. But the percentage of shares owned by individuals, you'll see, declined very rapidly. So 88% in 1955, 83% in 1965, around 70% in 1970, and then dropping a bit more sharply to around 54% in 1985, staying there for a while, and by the year 2005, again dropping another large amount to around 30%, and in 2007, finally, just around 25%. So if the importance of individuals has been declining in relative terms, who are the shareholders today? If we go a bit down further in the table, we see that the first big category to really grow a lot are pension funds, which were of negligible importance in 1945, but we see particularly in the period between, say, 1965 and 75, pension funds increased to about 16%. 1995 are going up to about 23%. And have been kind of stable there, that roughly 1/4 of all shares in the United States stock market are owned by pension funds. Another trend is the role of mutual funds. Mutual funds are investment funds where basically they pool money together from different individuals and invest in more broadly diversified portfolios than would be possible for a single individual. So a lot of individual share ownership was shifted. Instead of people buying small stocks directly in individual companies, individuals would buy shares in a fund which was managed by a professional mutual fund manager. We see this a bit later from around in 1985, around 5%, going up to about 12% in 1995, and up to around 22 or finally 25% in 2007. So again, about 1/4 of all stocks in the United States are owned by mutual funds, and together pension funds and mutual funds make up, over half of the total share ownership, or around half of the total share ownership in the United States. If we look at some other countries like the UK, we see a rather similar trend over time. Going back to 1963, individuals owned 54% of all total stock of British companies. This number declined to even a much lower level in the United States, to just around 12 or 13%, right up before the financial crisis. In the UK, we see a slight variation of the theme of institutional investors becoming more important. In the UK, we see a rise of stock held by insurance companies, which was increasing from 10% up to a peak of about 22%. We see also a rise in pension funds from around 6% in 1963 to a peak of around 30% in 1989. Now, pension fund stock has declined somewhat, and we see a increasing number of other kinds of funds like unit trusts, investment trusts, and other financial firms. A big difference between the UK and the United States is the big increase of foreign ownership of British companies, which is quite massive, some of which are also US pension funds or pension funds from other countries. So we don't know if we put UK pension funds and foreign pension funds together. Again, the share of institutional investors here would be quite high. What significance does it have to, when we see this rise of pension funds, what does it really mean for corporate governance? To understand that, we need to understand some basic differences between individual investors and institutional investors such as pension funds. With individual investors, stakes are small. Individuals tend to have only a very tiny proportion of the total stock. Also, individuals, the cost of gathering information about company is quite high, and it's very difficult for lots of separated, isolated individuals to coordinate their activities. So imagine you own some shares and you're going to a shareholder meeting. It'd be very hard for you to contact and communicate and coordinate the agenda of the meeting with one of the thousands and thousands of other shareholders. So for the most part, if individual investors are not happy with the shares they own, they would exit, right? Which means they would try to sell their shares. Right? So the cost of engaging actively in the governance of companies through shareholder activism would be quite high. Now, this picture changes a bit when we look at pension funds. Pension funds pool together money, the retirement savings from many individuals, put this into a giant fund and invest it in companies. So that means even though they're not majority stakes, the stakes that pension funds own start to get a bit bigger. So we'll see very typically a very large pension fund might own 4 or 5%, maybe even more, 6% of a large company. Now, these large amounts of funds that pension funds have are diversified. So in Germany, for example, a pension fund might invest in, the DAX 30 or DAX 100. In the UK, they might invest in the FTSE index. US pension funds will also invest in the S&P 500, or the other kinds of, diversified index of stocks. So they basically buy things, and then because they're buying like stock in all companies, they tend to hold the stock for a long time. Pension funds have some professional staff who can spend more time to collect information about the companies that they're investing in. And at least to some extent, a very big pension fund might tend to exercise voice to become a little bit more active in corporate governance. A good example of that is CalPERS in the United States. That's the California Public Employees Retirement System, CalPERS, PERS. And it's basically the pension fund of all the teachers, professors, other kinds of public employees in the state of California. California is a very big state, and this is really one of the biggest pension funds around. So this kind of fund has a lot of capacity to professionally manage money and to kind of take care in terms of the stocks that they own. Now, what do pension funds want? This is an interesting question. Of course, pension funds themselves are organizations with certain kind of duties to the individuals who invest their money into the pension funds. So the pension fund itself also has a fiduciary duty to the policy holders, the pension holders, to maximize the financial returns on those investments. So when we compare the potential for shareholder activism between individuals and large pension funds, there are at least something of a greater potential for pension funds or other kinds of large funds to play a very active role in the governance of corporation, and can be something of like a monitor to actually exert some kind of control on management. Now, it's very important to understand why did this happen, where do these kind of pension systems come from. So here we're going to take a small excursion so I can explain this to you. If we think about how individuals save money for their retirement, most in Western democracies, advanced industrialized countries all around the world, you find the welfare state, which has a pension system, a public system for providing some kind of retirement income. And these systems start with the first tier, in which all persons kind of participate in it as a kind of mandatory thing. Now, the income that you get when retirement on this kind of public system is usually very basic. It's usually ended up as a kind of minimum pension that you might have. So most pension systems then have a kind of second tier, which may be a public tier or private. Now, the goal of the second tier of a pension system is usually to make sure that people save for retirement at a level of which is similar to the level of income that they had during their work life. So there's some relation between how much money you pay in and how much money you get back out. So the German system is basically like this. It's a very workplace and employment-centered form of retirement, where each month you pay into a public system. And then according to a system of points, there's a defined benefit. When you retire, you get a certain percentage of your income paid out to you as a pension. Now, in some countries like the United States, the UK, but in other places, a lot of this second tier from a pension system takes place not in a public system, but in a private system, in which, similar to Germany, money is deducted from your paycheck each month. But in this case, it would be paid into a privately organized pension fund, which accumulates this money as cash and then will invest it. Those private pension funds then can be of two types. One type is a defined benefit scheme, in which you know, when I retire, I'll have a certain percentage of my income as a benefit paid out to me. But increasingly, these systems are also defined contribution, which means a certain amount of money is paid in. The fund manager tries to invest and grow this money, and you simply get at the end, when you retire, whatever that portfolio of money is worth. Okay? So there's obviously a lot more risk on the individual in a defined contribution system, but potentially, if the investments go well, your retirement could grow faster. Okay? Now, in every country, of course, there's always a third tier, which is the completely voluntary forms of savings. These are usually private, but some of these systems also put the kind of private savings into funds, which are invested in the same way as the other kinds of second tier private pension funds. Now, the tier one public system of pensions, or the tier two of public mandatory pensions, is more generous in some countries than in other ones. If we imagine that when we retire, we have a kind of target replacement rate of 55% of our average earnings, we see that, for example, maybe not surprising, that in Norway, the mandatory state pension is quite generous, and it almost achieves that replacement rate, so that individuals only would need to have a very small pension gap where they need to make up money from private savings or private pension funds to achieve that gap. Now, Germany is a fairly generous public system, and again, in Germany, this replacement rate will be around 40%, which means, well, okay, it's maybe not quite where we want to be, but we need to engage in some kind of private savings to make up this other 15%. So there's some role for other kinds of pensions. But when we go to countries like the United States or the UK, Japan, you can see that this percentage is getting lower, and there's going to be more scope and more need for private pension funds to make up this kind of gap. So, for example, in the UK pension system, the state pension is basically this very basic system. It pays a flat rate. Used to be about a quarter of your average earnings, but its generosity has declined, so that if you just had the state pension by itself, it would only replace 15% or less of your earnings. It wouldn't really not be enough to, get you very far in your retirement. So there's a second tier of the state pension, which is related to your earnings, and about half of people remain contracted in, which means they participate in the state scheme, and the money that they collect, they pay each month into the pension fund, is filtered through the welfare state and paid out to people retiring. So it's a kind of pay-as-you-go scheme. But 50% of people contract out from the state scheme and put that money in cash, in actual savings, into pension funds, which accumulate the savings in investment. Okay? And then again, we have the third tier of individual savings, in which, again, there's a lot of tax savings if people, instead of taking money as income and putting it in the bank, they can defer income taxes and put that money into certain kind of pension-related investments, and it won't be taxed at the same rate as income that you put into your bank account. So there's a lot of this third tier of money going into pension funds through the kind of tax incentives for individual saving. Now, these differences in the political economy of the welfare state and the way countries save money for retirement, either through as a pay-as-you-go or through a funded system using pension funds, has a big difference on the financial system and ultimately on corporate governance. So this table is showing you the total assets of pension funds as a percentage of gross domestic product. And we see that some countries like Denmark, the Netherlands, Switzerland, and the United States have a huge pension fund sector. The Danish pension fund sector is has assets worth 200% of the entire economy of Denmark. In the United States, it would be 145%. In the UK, it would be just about the same size, so the total assets of the UK would be equivalent to the total gross domestic product of the entire country for 1 year. So these are very substantial, huge funds, and we're going to see a lot of that money is going into stock markets and therefore playing an important role in the question of who are shareholders and how corporate governance operates. Now you see in a lot of Asian countries or somewhere in between, Japan and Korea have a kind of growing pension fund sector, but it's just around 25% or 30% of the economy. Now, I'm spending so much time on this topic because I think for many of you the topic of pension funds might be a little bit new. It's something we don't worry too much about in Germany because the public system is so generous both in the first tier and in the publicly funded second tier, so that the third tier of pensions, or the private system of pensions in Germany, is not so big. So we see, where does Germany rank? Well, just around 7% of GDP. So the total size of pension funds relative to the economy is quite tiny. It's about 1/20th of the level of the United States, for example. This next slide shows very similar data on pension fund assets. It's just showing you here the total dollar value in billions of US dollars of pension funds, right? And in the next slide, what I'd like to show you is how those assets of those funds are allocated. And you see here on the left-hand side a distinction between equity investments, bonds, other, and cash. And particularly when we're talking about equity, we're talking about investments in stocks of companies. So you see that in the UK or US, almost 50% of these huge pension fund money is invested in the stock market in the shares of companies. Even in the Netherlands or Switzerland, this percentage is about 1/3. And so typically a large proportion of that money, when you have it accumulating in pension funds, finds its way to the stock market. Now, if you just look here at the UK and the US, the second column, this is the distinction between the defined benefit type of fund, where you know how much you're going to receive at the end, and the defined contribution type of fund, where you're investing in the hope of maximizing a return. And we see that even though in most countries, like over 90% of the money is in this defined benefit type of scheme, we see some move away from that. In the UK, it's just about 80%, so it's a bit less. But in the United States, only about 40% of this money is defined benefit, and 60% of the fund money operates on a defined contribution basis, which means that the managers of funds and the policy owners behind those funds are really looking to invest in high growth and maximize the returns to shareholders of these investments so that they're going to have an adequate retirement one day in the future. So when we talk about pension funds, but also mutual funds and other kinds of large funds that manage other people's money, we're talking about institutional investors. Any kind of fund and fund management which takes money from the general public, pools it together, and invests that money in a kind of managed professional way. And the rise of these so-called institutional investors has really changed the nature of share ownership and the ways in which share owners interact with companies. So why this new role in corporate governance? Well, the very large size of these funds and the large size of the stakes, the blocks of equity that a fund will have in a particular company, limits its liquidity. It's hard for CalPERS to unload its shares of, say, Volkswagen very easily without taking a substantial loss. At the same time, though, having a bit of a larger stake gives them the ability to vote a significant block of share ownership. Now, if we think in terms of burden means, even a large stake of 5% isn't really going to be that much. But if different pension funds vote together or think in a similar way, their combined role might be quite important on management. So it's still a significant block. And it's a big enough block that it gives these professional fund managers the ability to communicate directly with managers. So as an individual shareholder, usually we don't, say, contact the investor relations or the CEO of a large company with our question that we have as an investor. However, there's quite a large system of public relations, analyst meetings, and so forth, in which managers, be that in the investor relations department or even the top management of companies, communicate directly with the fund managers from large institutional investors to answer questions, to keep them informed. So there's something more of an informal dialogue that happens between institutional investors as share owners and corporations, which we don't really see in fragmented individual share ownership. Now, beyond that, there's some resources, at least in some types of funds, for genuine shareholder activism. And again, CalPERS is a prime example of this, where they use the resources they have to really collect information about companies. They have campaigns in which they might mobilize other investors. They can also make publicity. So CalPERS sometimes will name and shame, for example, the most overpaid CEO in the United States. So among certain kinds of funds, at least to some extent, there's a new focus not simply on profits, which are also there, but also on playing an active role in corporate governance. So now we're going to turn to the question about how effective institutional investors might be in solving some of the agency problems that we discussed last week. So if institutional investors have the potential to become involved in corporate governance, why would they? What are the kind of issues that are concern to institutional investors that might prompt them to communicate or engage with company management? Well, first thing institutional investors could care about is the company's strategy, what sort of products and services the company are making, its potential for growth, its position vis-a-vis competitors. This would relate to the company's operational performance, the financial bottom line, what's the return on actual investment the company's succeeding in making. Institutional investors will also care about companies' acquisition or disposal of major assets. So buying another company, selling a line of business, and so forth. Turning to the structure of corporate governance itself, what sort of organizational things would an institutional investor like to see? Well, it's quite likely that an institutional investor would advocate having an independent member on the board of directors, someone that isn't involved in the day-to-day management, but can take an outside, independent view of the company's strategy and the things we just mentioned, with the idea that this independent director can hold the executives properly to account. institutional investors would be concerned about having a good system of internal controls, and they get worried if they think the system of accounting and audit have problems. They could worry about inadequate succession planning. So what happens when the top management steps down? Who will become the new manager? In many countries, corporate governance takes place through codes of good corporate governance, recommendations that companies should adopt in order to provide good corporate governance. So generally speaking, an institutional investor might be interested whether a company complies with these kind of codes, like the Combined Code in the UK or the German Corporate Governance Codex, and they might be concerned if a company is out of line with those codes. A further aspect concerns remuneration, the salaries of the top management, and whether the company might have inappropriate incentive packages, excessive pay, or too comfortable severance packages that when a manager leaves the company, they would take too much with them. Beyond that, even institutional investors could be interested in corporate social responsibility issue. What are the kind of risks that the company is facing with regards to its social and environmental behaviors, and how do they position themselves in relation to these issues? Increasingly, we can see that institutional investors look to each other in terms of what should their role be in terms of corporate governance. A good example of this in the UK is the Institutional Shareholders Committee, which issues a set of principles regarding the role of institutional investors within corporate governance. The members of this committee were the Association of British Insurers, Association of Investment Trust Companies, National Association of Pension Funds, and so on. They defined that an institutional shareholder's primary duty is to those on whose behalf they invest, for example, the beneficiaries of a pension scheme or the policyholders of an insurance company, and that institutional shareholders must act in the best financial interest of those types of investors. So, how do institutional investors then actually intervene into corporate governance? And here, this mostly occurs if a company performs badly, if it doesn't meet the kinds of expectations that the institutional investor has on the company. And then on a case-by-case basis, an institutional investor might do one of several things. A first thing they might do is hold some additional meetings with the management specifically to discuss their concerns. So they can reach out to the company, they can be in contact, they can express their opinion or seek more information. They can also do this indirectly by expressing concern through the company's different advisors. They may meet directly with the chairman, a senior independent director, or with all of the independent directors. Now, a further step that they could take is to intervene jointly with other institutional investors regarding particular issues. We're going to see that this is a bit rare, but it may be possible for investors to get together and to coordinate and exert some kind of common pressure. If things are still not being satisfied, they can also do things like make a public statement in advance of the shareholders' meeting, basically trying to draw public attention to the issue, get journalists involved, and try to mobilize other shareholders. Now, an institutional investor could take a further step to submit an actual resolution, something to vote at during the shareholders' meeting. We talked last time about the percentage of no votes that we see at shareholders' meetings is quite low, but again, this is a further step that an investor might take. And in very rare circumstances, the institutional investor may request the call for an extraordinary general meeting if there's a particular emergency situation in which they feel the board of directors should be changed. So all we've said up to now is that institutional investors have some potential to be active, and they may have a series of issues which interest them that may promote this activism. Now, it turns out that different kinds of institutional investors may be more active in corporate governance or less active in corporate governance. Our reading for this week looks at some of the factors which determine the degree of activism and how much an investor actually behaves more like an owner of a corporation rather than merely the investors in a kind of financial instrument of shares. Well, a first factor is simply the size of the fund. Larger funds tend to engage in more activism than smaller funds. We said some reasons for this already. Their stakes are harder to sell, so they're more stuck into the relationship as shareholders, but at the same time, their larger size may give them more power, more potential influence to get the manager's attention. A second factor is funds with longer investment time horizons tend to engage in more activism than those with shorter investment time horizons. So compare a pension fund with something like a mutual fund. Well, in theory, a pension fund takes money that you save now, and your retirement may not be for another 20 years. So the time horizon of the investment of a pension fund tends to be rather long compared to, for example, a mutual fund, which is trying to make a return on investment every quarter, or at least in a shorter time horizon like a single year. Funds may bring a variety of financial but also non-financial performance expectations, and those with non-financial expectations may engage more than purely financial funds. What does this mean? It means that some types of pension funds or other types of funds may consider socially responsible investments, may consider some of the ethical implications of the companies that they invest in, and it's those kind of funds that consider those non-financial aspects that might be more likely to ask questions or become involved as responsible owners of a company. Our next factor gets into a bit of theory, and if you look in the article for this week, we can read much more about that. And it's the distinction between a pressure-resistant fund versus a pressure-sensitive fund. What do we mean by pressure? Here we mean pressure from the corporate sector onto the management of the fund itself. I talked about CalPERS as an example of a activist fund. Well, CalPERS is the fund of the public employees. Right? So it's the people who work for the state of California, for the government sector, not for other private companies. So you can imagine that CalPERS is fairly independent of the corporate sector. Now imagine another big pension fund, such as Hermes Pension Fund, which belongs to British Telecom. British Telecom is these days a regular stock exchange listed corporation itself, and it might be a bit strange or unlikely if that kind of fund would go around and being very activist and challenging management of other firms, including, for example, British Telecom itself. So you might imagine that this fund, which is set up by the corporate sector, may be more pressure sensitive regarding activism than a more independent one. So funds tend to engage in more activism if they own a higher percentage of the stock, if a particular stock represents a large part of their portfolio, or if they have a high level of equity in their mix of assets. Defined benefit funds, funds that are concerned with long-term benefits they have to pay out, may be more likely to engage in activism than defined contribution funds, which are again concerned with shorter term profits, and funds with certain kinds of structures in place in terms of the governance of the fund itself will be more likely to engage in activism. For example, if a large part of their portfolio is run through passive rather than active management, passive meaning they buy and hold stocks rather than actively trading and churning them. If a large part of their portfolios is managed externally, or if they exercise voting rights themselves rather than delegating proxy votes to an outside company. So the article by Ryan and Schneider that we're reading this week presents a theoretical model of institutional investor activism that gives you a spectrum from very active to very low activism. And we see that what they categorize as high activism funds are those public pension funds where basically all those criteria are met: the fund size, the time horizons, expectation, pressure sensitivity, and so forth. Private pension funds have some of those features, like the long time horizon, but they have a very different performance expectation because, of course, they're private pension funds operating in a market. And for many of these items, there's sort of an intermediate category. Now, for the purposes of this class, you don't need to worry about the next two types, the Taft-Hartley funds or the TIAA funds. These are particular kinds of funds in the US context. But I would like you to think a bit about mutual funds, funds which are just private investment vehicles, profit maximizing, but they're not specifically designed around pension. These also have somewhat large size, but a much shorter time horizon, and they may be fairly independent of the corporate sector, but some of the other features that they have are more sort of intermediate level. Okay? And when we look at insurance companies or banks, we see that they're fairly low on most of these criteria. So in short, there's different degrees of activism that we can observe. Public pension funds being the most active. They're managed usually by persons who are elected by government or union officials. There's political oversight. And a lot of the famous examples of activism that we see, such as CalPERS, are of this type. So it's a kind of famous but rare case, right? When we compare other types of investment companies or private pension funds, they're less active. We can see mutual funds and money managers control them. They have diverse clients. And in private pension funds, it's also the case that the fund managers themselves are often elected by corporate managers, and they're a bit less likely to rock the boat and become very active on corporate governance subjects. Shareholder activism by institutional investors has really transformed corporate governance. It's made shareholder interests much more prominent. It's really had a big impact on the business culture, on the development of corporate governance. Does it really solve, though, the problem of agency? Well, I would argue that there's important limits to shareholder activism that we should be aware of. A first one is that many institutional investors, the so-called pressure-sensitive ones, do have important conflicts of interest. It turns out that mutual funds and other kinds of funds may adopt pro-management stances in corporate governance when they're dependent on other kinds of business from corporations, such as managing the corporate pension fund. We'll see this kind of conflict of interest later in the course when we talk about gatekeepers and the role of accountants, auditors, lawyers, and other independent groups which may often develop these kind of conflicts of interest. So when we think about the degree of activism, we can think of it as increasing the more independent that the fund gets from the corporate sector itself. A second issue is simply the lack of organizational capacity to engage. Engaging in shareholder activism is, at the end of the day, quite expensive. Even the biggest pension funds often delegate the management of particular portfolios to outside specialists. And institutional investors who are outside of those very biggest ones may often rely on external service providers like the institutional shareholder services or other third-party companies to basically to engage in proxy voting for their shares, to rate the companies or inform the funds how to vote. So although funds are big and they have some capacity, we shouldn't imagine that they have a lot of time for individual companies. Finally, even if institutional investors overcome these conflicts of interest, shareholder activism tends to remain very general. What do we mean by that? Well, if we look at CalPERS as an example of a very highly developed system of shareholder engagement, what CalPERS usually does is engage and advocate across the board guidelines, which means they'll come up with some ideas about what is good corporate governance, what should companies be doing in general, and they'll kind of campaign and push for that. So they'll have explicit policies for voting their shares in line with those principles. But do those strategies really impact the corporate governance of particular firms? There I would say it's relatively limited. Right? So CalPERS may push for better forms of pay for top management, certain kinds of board structures, things that can help reduce agency costs. But at the end of the day, CalPERS is an investor. They're only going to behave like a true owner to a sort of limited extent. So I'd like now to give you a little bit of flavor about how fund managers themselves think about their role in corporate governance. Now there might be some tensions or contradictions in these different quotes, and you can think about them and reflect on them in your own time. The first one comes from a pension fund manager who says, he's talking about corporate social responsibility, and he says, to be perfectly honest, we're not very big on CSR, partly because I'm not sure it's my role to decide what's ethical. We expect that the companies we invest in to obey the law. What interests us most about the companies we invest in is the economic outcomes, business performance, and the structure of the company. Our aim is to make money. So here we say there is some interest in corporate governance. They care a lot about the firms, but the kind of role that they're seeking to play as an owner is really fairly limited to that of a financial investor. They're not really, in some sense, behaving like an owner who would then also carry responsibility for the company and its products. Let's look at the second quote. This is from a corporate governance specialist within a fund management company. He says it goes back to how do you define corporate governance and how you end up reporting to the client what you did. You may have a fund manager who may not portray great interest in the corporate governance agenda, as it's often thought of with the codes and so forth, but that fund manager may be the most activist in terms of actually meeting companies. This is almost a pure form of the active owner, but they may not pay interest to the agenda of making sure audit committees are independent. One may have a fund manager who pays attention to the corporate governance agenda, but is not too keen on getting stuck in companies. So what's going on here is that there's certain kind of practices, best practices, and recommendations that are often given to boards of directors. And again, what we said in the example of CalPERS is that oftentimes that activism is just trying to promote those best practices in general, but that funds don't spend too much time with particular companies. Now this guy's describing a kind of mirror inversion of the case where the person doesn't care too much about the formal aspects of corporate governance, but is actually spending quite a long time with individual companies. So there's a kind of gray area here in different ways in which you could think of fund managers as being active or not active. Our last quote on this page is again from a corporate governance specialist within a pension fund. I think there are a few people out there who have a business-driven model, and so they want to make some noise because they'll make money from that business. That's not what we're doing. We're just protecting the interest of trustees. We haven't even got the name in the papers. So this is about the kind of public visibility of corporate governance activisms. Sometimes it can be very public with a big splash, can be used to create pressure, but many kinds of shareholder activism are really more behind the scenes, and they're not aiming to make a public impact. In that way, they're sometimes hard to measure or hard to really even know about from the outside. So these are some quotations from interviews that I did in the UK, in the City of London, with fund managers before the 2008 financial crisis hit. Now, agency theory, and to some extent a lot of the thinking inspired by Berlin Means, takes the idea that shareholders should exercise control of corporations as granted. Good corporate governance seems to be associated with shareholders being active and behaving like true owners. And so we could think of shareholder activism as a good thing that's reducing agency cost and basically producing beneficial effects for the economy as a whole. Well, before we go to that conclusion too quickly, we should think about what managers have to say. Do they think that shareholder activism is a good thing? Or what kind of counter arguments might managers provide? For example, if they don't want to follow the recommendations of shareholders. Here's a few common arguments. See what you think. A first set of arguments is that investors' time horizon tends to be too short. Investors are too focused on quarterly reporting. Sometimes they have fantasies of unlimited growth, that earnings will go up and up every quarter and never go down. And they may not truly value, or they may undervalue, important long-term strategies, particularly in the area of research and development, which may cost money today, but take a very long time to pay off in the future. So a first set of arguments is simply that shareholders are too focused on the now and not thinking about their own long-term interest. A second set of arguments which are related is that investors may have very limited qualifications to actually advise companies. Most fund managers don't have industry experience outside the financial industry and outside managing funds, and they may lack information and expertise, knowledge, and experience to really judge business strategies. A third and somewhat less common argument is simply to say that investor authority is not legitimate. This is the idea that not only shareholder interests matter, and that what a manager's role is to serve a wider group of stakeholders, most obviously customers, but also communities, employees, to uphold environmental interests. And that the idea that the goal of the company is to produce shareholder value, or that shareholders have a kind of higher moral status within the governance of the firm, is simply wrong. Now, it's interesting to see if you look maybe in company reports or interviews with top managers in Germany in 2020, would you recognize some of these arguments? How far would managers go in terms of focus on shareholders or focus on wider kinds of stakeholders? This is a topic that we're going to come back to again and again throughout the course. Now, so far, we've talked a bit about the stakeholder model, but not really very much about social responsibilities. And you might ask, say, well, do all shareholders really just care about these bottom line financial returns? We saw that it's often the case. Think of the quotations that I just read to you. But there's a small but still growing segment of investment funds which fall under the title of socially responsible investment. Sometimes might these days be called sustainability or ESG, environment, social, and governance type of funds. The label is less important than the idea that these are funds that focus on criteria of social responsibility. This is a growing area. Its overall volume is low, but it's a very interesting case study in how pension funds or other types of investment funds can themselves be governed. So this raises a number of questions. How can investment funds actually find out whether or not firms they invest in are behaving ethically? How can funds measure the social or ecological performance of companies? And how can these types of funds maybe pressure firms to change their behavior to become more sustainable, more ecological, and reduce risks coming from socially inappropriate behaviors? So again, sometimes this falls under the topic of sustainability or ESG, the idea that companies should care about environment, they should care about social impacts of their behavior, and they should follow good principles of corporate governance. So here we start to see the link between CSR and sustainability topics that we're going to come to much more in the second part of the course, and the kind of core issues of corporate governance and the nature of the corporation that we're talking about in the first part of the course. So when we think about socially responsible investment, again, we have a quite complex world and a whole set of infrastructure, which starts, of course, with the investors. They could be large pension funds like CalPERS that do pay a lot of attention to these sustainability criteria. They might be smaller, more specialist ones. And to make a kind of market for these investments, we see that stock exchanges like the Dow Jones or the FTSE in the UK have certain segments which companies can become a member of if they fulfill certain types of criteria about information disclosure and about their performance in relation to these ESG criteria. So, for example, the Dow Jones Sustainability Index or the FTSE4Good. Now, evaluating companies' behavior along the social dimensions is a very specialized and complex task. Just in the same way we have financial analysts who look at the company's books, try to evaluate the quality of their earnings in the long term. In the same way, we have a whole industry of ratings agents who try to provide measures, metrics, and information about the socially responsible activities and environmentally responsible activities of large companies. You might have heard of some of these, like Sustainalytics, Asset4, and many others. So how significant is socially responsible investment, and how does it really work? Well, again, the scope of this is modest but growing. It's estimated that about 11% of managed fund assets in the United States use some kind of sustainability or socially responsible criteria. It's estimated that this amounts to about £10 billion in the UK, and we see the importance of these different European, British, and US indices, which represent a substantial portion of the stock exchange. Oftentimes, to be included in an SRI fund or in this kind of index, A first step is a so-called negative screening. So there's certain controversial ethical issues that, depending on the orientation of the fund, they may want to eliminate certain things. For example, animal testing, genetic engineering, looking at health and safety or environmental impact, human rights issues, military production, nuclear power, pesticides, pornography, and so on and so on. So again, depending on what's the orientation of your fund, some of these early funds were religious funds, so they would really avoid, for example, tobacco, alcohol, pornography, military funding. But these days, a lot of funds are more concerned with, say, environment, green energy, nuclear power, and so forth. So first step is maybe to not invest in any company that fails to pass these negative screens. Then within the world of potentially responsible companies, you can have a bunch of positive criteria. So you can try and evaluate to what extent a company is involved, makes a positive impact on community, that they have a sound corporate governance structure, they disclose information about their environmental activities, that they provide equal opportunity, they provide positive services and products, that they manage their supply chain responsibly. So again, making this kind of positive criteria is maybe a little bit more tricky, and we can imagine there's quite a lot of different ways in which you might do it. Now, a key limitation of any SRI type of screening is the information about corporate responsibility and also about bad behavior of companies, is it really comparable across firms? So for example, the way companies report carbon emissions, do they report carbon emissions? Is the way that it's calculated and reported comparable across firms? This is quite tricky. Furthermore, is that information verifiable by third parties in the same way that financial information should be auditable and verifiable by accountants and audit firms? So here I encourage you to look at the video below about United Nations framework for SRI criteria. Before we leave the topic of ownership and the structure of shareholdings, there's one more very important topic that we need to cover. It's very important for understanding the problem of agency and the kind of ultimate power that shareholders may have after all. And this relates to the market for corporate control. Sometimes in everyday language, this is referred to as the topic of hostile takeovers. Here you see an executive with the head on the wall who is a victim of a hostile takeover. This is something that is a kind of final step in the potential for shareholder interests over managers. So it's something that managers tend to fear and may care a lot about. So the first thing to get into this topic is to think, what happens if agency problems are large? If managers of firms don't focus on those activities which maximize the wealth of shareholders? What happens then? Well, economists, of course, say that's bad, and managers need proper incentives, or they need to be replaced. And if shareholders have trouble to replace management, the idea here is that there would be a market for corporate control, which could perform this function of disciplining poorly performing managers. The idea of a market for corporate control was first really theorized by Henry Mann in 1965, who had the idea for the first time that the market for corporate control could have a governance function. And for here we have to think a little bit more about what happens if a company's management is performing very poorly. Well, one thing that may happen is that the stock price will go down because investors will lose confidence in the management. They may start to sell their shares, and slowly that stock price will decline. Now imagine that it starts to decline a lot. Okay? Henry Mann argued the lower the stock price relative to what it could be with more efficient management, the more attractive the takeover becomes to those who believe they can manage the company more efficiently. So imagine a big company and the management team's not doing well, the price goes down, it goes down some more, and imagine there could be some price at which a smart manager thinks, well, gee, if I took over the company, bought it up, bought all the shares, fired the management, and replaced the management with a better team, it would be very easy to boost the stock price and make back that money. Okay. So the idea here is that there's some price at which an outsider might become interested to take over the firm, buying up all the existing shares and changing the management team. Now, this assumes a very strong relationship between share prices on one hand and the performance of managers on the other. And if we believe that these things are strongly related, then it's possible to theorize about a kind of market-based governance mechanism. And the interesting thing about this market-based governance mechanism is that it fits very well with the preferences and behavior of small shareholders. Because most small shareholders, when they detect a problem with the company, they're going to exit. They want to sell their shares quickly, they want to get what they can, and leave the problems for someone else. And we, up to now, have been thinking of that as maybe a problem of corporate governance. There's no owner who could be a responsible owner and take care about the company. Everyone's getting out fast. But, okay, what's going on here is this drive of small shareholders to exit when agency problems are getting very large may create a market incentive for someone to take over the company. And when you take over the company, of course, you rejoin ownership and control because you reconcentrate those shares. Now, that price has to be quite low when we're talking about very big corporations, right? But what I'm trying to introduce you to here is the idea that takeovers, the topic of mergers and acquisitions, the buying and selling of companies, actually can be an important element of corporate governance. Now, the story of the market for corporate control or takeovers is really a final part in the narrative that I've been sharing with you about the experience of the United States. Last week we talked about Berlin means, the separation of ownership and control, and a long period in which managers in the United States were really quite entrenched. There was not really any challenge for them from outside shareholders. This continued through the 1960s. And one of the things that happened, maybe you've studied this in business strategy, if you've talked about Alfred Chandler, is the rise of large conglomerates, that managers started to diversify the portfolios of business of large corporations to spread risk and make corporations very large and complex, having such a wide array of business things. Now, along comes institutional investors that we've been talking about today, pension funds, mutual funds, and they put the interest of shareholders again on the agenda, creating some pressure, engaging in activism, and starting to push for some changes in corporate governance. Now, if we take a step for just a short moment into finance theory, it turns out that institutional investors don't really like to hold the shares of these big conglomerate firms. Shareholders, particularly institutional investors, they like to diversify their portfolios themselves, right? So they want to be able to decide exactly how much of their money they put into different types of businesses. Now, when they have the choice to buy the shares of a conglomerate, in some sense, when they buy that one share, they're buying into a kind of portfolio already, which, well, basically, it makes them difficult to manage exactly how they spread risk. So there's some kind of preference on the side of institutional investors. They would rather have sort of a structure like one company, one type of business, and then it's sort of themselves in the stock market who diversify risk. Now, this idea was referred to as the conglomerate discount, and it was discovered by some financial economists that the share price, something like the price earnings ratio, was a bit lower for these diversified conglomerate firms than it was for other types of more specialized focus firms. So this kind of discount became a kind of tool for private equity funds and other kinds of funds specializing on takeovers to start to target these firms, and created a wave of takeovers during the 1980s in the United States. These kind of takeover funds targeted diversified firms that were taken over at a very high rate. Many of these takeovers came to be known as hostile takeovers because the management of the target company didn't want to be taken over. Those managers wanted to keep their jobs, continue running the business as they had been, but the fund would come along and make an unsolicited offer to all the shareholders to buy up all the shares at a certain price. When takeover funds succeeded, those target firms were then often split into component businesses and resold. Basically, they took the company over, split it up, and sold off the parts to acquiring firms in the same industry. And in this kind of buying, breaking up the firm and reselling it, there was enough profit margin to recoup the investment and make a good amount of money by changing the management strategy of the company quite radically. So I'm sure the story I've told you so far may sound quite convincing. If firms are undervalued, if the management is poor, it would be efficiency enhancing to take over those firms, replace the management, solve the problems of agency, and then increase the value of the firm. Now, there's always a difference between theory and practice, and it turned out that a lot of the discussion around hostile takeovers pointed to quite some controversy. A key issue that we can question is the idea of this link between the share price and the quality of management. Now, also thinking again in terms of finance theory, we know that stock markets may often value corporations below their true market value. For the stock price to reflect that value, investors in the market need to be able to correctly evaluate and value management strategy. But we know that capital markets and investors often behave in myopic ways. They may be irrational. They may follow trends. They may get nervous. They may take rather shorter term views of their investment because, as we discussed earlier, their time horizon may not be sufficiently long. Other economists then criticize takeovers as being opportunistic, as exploiting these inefficient share prices, and pointed out that they were often motivated simply by a redistribution of stakeholder wealth, that the buying and breaking up of companies, the changing of employment conditions represented something like a breach of trust. Critics also pointed out that, well, where did the funds get these large amounts of money to buy these very big corporations? And oftentimes they took on very high levels of debt. So they borrowed money, basically, bought the firm, sold it again, but in theory then repaying the debt. But a lot of times it was the corporation themselves that became liable for that debt which the owners had issued to take over the company. So it turned out that these leveraged buyouts, buyouts that use high amount levels of debt, turned out to be quite risky. And there's some interesting cases where this went badly. If we fast forward to 2020, or maybe more around the time of 2010, in Germany there was quite some public debate about these types of funds, private equity funds and hedge funds that were engaging in a particular kind of shareholder activism of trying to target undervalued companies, take them over, and really actively change the management policy. On one hand, it seems like these kind of funds are behaving as owners, right? They're taking responsibility, taking a large stake in solving agency problems. But at the same time, the way these companies are managed, their use of debt, the kind of tactics involved in buying and selling the companies and changing its operations have been quite controversial and remain a kind of frontier topic today in the study of corporate governance to better understand the strategies and governance role played by these type of funds. Now, given these controversies about what happens to stakeholders, given the challenges to managers who maybe don't want to lose their job if their firm is taken over, it's probably not surprising that corporate managers try to defend themselves. There's a very colorful area of what are called takeover defenses, which are measures taken by a targeted firm, usually the board or its management, to avoid acquisition. These have very colorful names: poison pills, shark repellent, white knight, and so forth. I'll explain some of these briefly. A poison pill is a policy by which the target company issues new shares to existing shareholders at a very low price with the aim of diluting the stake of the acquirer. So say I buy 40% of your company. I'm in the process of acquiring another 10% to get a 50% stake to have control. But say the company itself now issues a bunch of new shares in the market that then water down the share that I have. This is called a poison pill, which is to say that if I start to buy shares in your company, I'm going to have to swallow a lot of poison because I'm going to have to keep buying and buying and buying shares. Now, this instrument is considered very aggressive. It's somewhat common in some parts of the United States, but you can see that it potentially violates legal rights of small shareholders. It may create something resembling between a type 1 and type 2 agency because the behavior of the company is favoring some shareholders over other shareholders. Another tactic is a shark repellent. This may be making amendments to a company charter that attempt to forestall a takeover event. For example, a charter might be amended to require that a merger must be approved by not just 50% of the shareholders, but it may require a supermajority of 80%. And again, this might make it harder for an outside fund to buy enough shares to acquire this supermajority. Now, a different kind of strategy might be a so-called white knight. The white knight is someone from afar who comes in, rides in on their white horse, and saves the day. So in this case, the target company doesn't want to be taken over by a hostile suitor, so they may try to sell themselves to be acquired by another company, a white knight, who they favor more in terms of the management. So kind of come under the protection of a friendly type of company. Now, a variation of this is the so-called white squire. A squire's lower rank than a knight, but the squire may be a third company who agrees to purchase a large block of the target company's stock to sort of protect it. Now, if all of these fail and basically it's impossible for management to avoid a hostile takeover, they may simply try to protect themselves. This is a typical strategy is called a golden parachute. So the plane is crashing, the management are jumping out, they put on their parachute, but the management has a golden parachute, so that when members of the board, for example, have to leave their jobs early, they get a severance payment, right? Basically a large sum of money as compensation for losing their jobs when new management comes in. So this is a somewhat, you could say, self-serving aspect of takeover defenses. It's not really meant to protect the company, but it's meant to protect the managers themselves. So it's, again, adding to the potential agency costs. So interestingly, although hostile takeovers are not very common in Germany, France, or Japan, the law in these countries is quite restrictive to these kind of takeover defenses. And oddly, although it's a very shareholder-friendly system, the United States is more permissive, at least in some states within the United States, of tactics like poison pills. And we see much more use of poison pill or white knight defenses in the United States. So there's kind of a more culture of hostile attempts, but also defenses against takeovers. So when we talk about the market for corporate control and the governance role of hostile takeovers, there's kind of differences across countries in how important it really is. In the UK and US, historically, particularly in the 80s, 90s, early 2000s, a bit less recently, there's rather more high levels of activity. There's high degrees of hostility, and it may be the case that those rather dispersed institutional investors, rather than becoming activist shareholders, are very happy to exit and sell their shares in less profitable firms and just get a kind of small profit from the outside bidder. In continental Europe or Japan, we see lower levels of activity. There were some first cases of hostile takeovers in the late 1990s, but mostly in these countries, shareholders are a bit larger. There's more block holders like families or banks who hold shares, and they tend to have longer term stakes so that they may hold their shares and not sell them even if a good bid comes from an outside bidder. So there's quite some debate in the corporate governance literature. On the one hand, promoting shareholder rights is an important agenda for solving agency problems, but exposing firms to takeover threats may be something that is seen as negative from a more stakeholder perspective, which is concerned with protecting the company as a social institution. So from a stakeholder perspective, it may be interesting to allow some types of takeover defenses, but then we're back to trouble with agency theorists who would see in many of these defenses a kind of discrimination against different kinds of shareholders and kind of unfairly being biased against bidding shareholders. So for the purposes of this course, what I want you to see here is simply that there's a potential governance role for hostile takeovers, but in the reality, it's quite a controversial instrument, something of a last resort, and it's something that can lead to abuses and also kind of cases where there's very unfavorable outcomes to stakeholders. Now, one quite interesting case, which I studied during my time of the PhD, was the first really prominent case of a hostile takeover in Germany. Okay. This was the Mannesmann Corporation. Probably many of you don't remember the Mannesmann Corporation because, well, it was taken over and doesn't exist anymore under the name of Mannesmann. Mannesmann had a long history in making pipes, so basically belonging to the German heavy industry, making having a kind of high-tech way 100 years ago to roll metal and to make large industrial pipes, but it was basically belonged to the steel and metalworking industries. Now, when telecommunications was booming and became privatized, and you had the first mobile networks in Germany, Mannesmann decided to diversify their business. So a bit like the conglomerate story we're talking about, leaving some of the old industries behind and investing into what were seen as new growing industries. And they were the first one after telecom to have the D2 network license. So here we see an advertisement by Mannesmann Corporation. We see a baby, we see names of the different telephone networks, and the caption here, es hat sich viel vorgenommen. This baby has big plans, dreams of the future. We see at the bottom, Mannesmann, think what the future could be. So this is quite interesting for German business culture because this is an advertisement run in the Handelsblatt or Wirtschaftswoche that was directly trying to appeal to shareholders to basically not sell their shares to the bidding company, which was, this will be familiar to you, the bidding company was Vodafone. Now, after this ad ran, the very next day, we saw the ad on one side of your screen. Again, the baby, this time drinking the mother's milk. This is an ad run by Vodafone. What does the caption here say? Jedermann weiß, wer groß werden will, braucht eine gute Mutter. Okay, so here, the idea of Vodafone as the good mother is going to take care of the Mannesmann baby, feed it, and nurture it into this new industry. So Vodafone, at that time, their strategy was to have rapid expansion throughout Europe in the mobile market. Now, a detail of the story was that Mannesmann, they had their old industry businesses. They also had the Festnetz, so the landline and cable to your company. And Vodafone said, no, this is not a good strategy. We should focus only on mobile. Okay. So the very next day, Mannesmann again replied to the Vodafone ad with quite a dramatic caption. Eine feindliche Mutter wäre das Allerschlimmste. So a hostile mother would be the worst of all. And if you look down to the very small part under the ad, there's a new caption there, which is showing this very rapid increase of the share price of Mannesmann. So pointing out shareholders, our company is really delivering value for you. Don't sell your shares. Well, in the end, institutional investors and individual investors sold their shares. They took the premium price paid by Vodafone. Mannesmann was taken over. The old industry parts were sold to Bosch and some other companies. The mobile business was absorbed in Vodafone, and basically that was the end of a more than 100-year-old, very large German industrial giant to the hands of a very younger British company which had more favor among the investors. So this was quite a dramatic story at the time, and you can get a bit of this dynamics or flavor from this of looking how the companies tried to appeal to the shareholders which strategy might be the best one and tried to convince them to sell or not sell their shares. What to remember for today. In the US and UK, we see that the era of managerial capitalism became increasingly challenged by the rise of institutional investors and a new era of investor capitalism. We talked about the good points and also the weak points of institutional investor activism, its potential to solve agency problems, but yet the degree of activism remains quite low. And then we talked lastly about the governance role of the market for corporate control, the idea that shareholder influence at the end of the day depends a bit on the possibility of shareholders to exit, to sell their shares, and the idea that this may trigger takeovers, which would challenge existing management and could potentially solve agency problems. And we discussed that this was a controversial instrument, which is more common in some countries than in others. That concludes today. I wish you a great week, and thank you very much for watching this lecture video.